I make it 11 o'clock, time to get going. So as usual, we'll run through some news first, and then we'll be looking at Pantheon. But actually, rather than looking at the trust, Helen Steers, who's our guest this week, is going to actually talk through a paper that they've done looking at the private equity sector, which should be quite interesting. So thanks very much. We'll get going. So to stick with the Pantheon theme, they've just managed to launch another trust. So there's Pantheon Infrastructure. We'll talk about that in a second. VHGlobalSustainableEnergyOpportunities is looking for more money. And Scottish Mortgage has some interim results this week that attracted a bit of press comments, so we thought we'd cover those. Pantheon Infrastructure first. So really did very well. So raised 400 million, which is at the absolute maximum that it was going to take. It was looking for 300, and it actually got more than that offered to it. So it was turning money away, and some people got scaled back. I wonder whether people have actually sort of got back in love with the idea of subscription shares again, because the experience with Carthew Digital seemed to go quite well. And the Pantheon Infrastructure Fund came with one subscription share for every 5 ordinary shares that you bought. So obviously these sort of give you a bit of a kicker on returns as the price climbs above, in this case, 101p. So this subscription share is going to be in our normal warrants subscription share sheet, which is on our website, and from beginning of December. Trading in these shares starts on 16th of November, on Tuesday next week. The portfolio is a sort of infrastructure version of Pantheon, the private equity company. So it's quite a diversified portfolio, investing in a range of different things. So much more than just the kind of normal social infrastructure that forms a core of most of the infrastructure funds. So some transport logistics elements in there, which actually have been cropping up a bit more in terms of roads and bridges and things. Ports too, perhaps. That's something that they've invested in the past, and even airports, maybe. Power stuff, renewable energy, energy efficiency things. So the sort of things you find in STCL or the Triple Point Energy Efficiency Trust. But also digital infrastructure, which obviously is the overlapping thing with Carthew and Digital 9. So that kind of broad spread of things, I think the diversified thing may have appealed to people. It makes direct co-investments in these projects rather than investing through funds, and that actually saves it some fees. And quite often, Pantheon's got a very good relationship with these managers, so they're the co-sponsor of the deal, or perhaps the only external investor in these. So I do think it's going to be interesting. It's going to be interesting to see how it goes. It's looking to make returns of about 8 to 10% a year. The dividend isn't particularly ambitious, and that's what I thought would hold it back. It's quite surprising that that didn't happen. Obviously, 4p in 2023 is sort of 4% yield on the issue price, progressive dividend thereafter, so we could be creeping up. But if you look at the yields on the existing funds, you'll see 3i Infrastructure is probably around that kind of 4% yield, but you could factor in the fact that it's on a big premium, unless there's discount at the top there. But most of the others are yielding a bit more than that. Carthew dividend is still ramping up, and that will go above 3. Same with Digital 9, really. So it may end up being at the bottom, towards the bottom end of the table on the yield front. So that doesn't seem to have held it back at all. I think that's interesting. So enough of Pantheon for the moment. We'll be back talking about it in a minute. VH Global. So we've talked about this one before on the show. And just to remind you, it raised 243 million back in February, and at the time that looked like a very good fundraise. So it's been incredible how much money has been raised across the sector since. It's now invested most of that money. So at the end of September, it's up to 92% invested or committed. And it's got a pipeline of opportunities lined up, including some that are ready to go now. So it's launched a fundraise targeting exactly £258 million, which seemed like a typo to me until I realised that actually it's what it's going to cost it to buy the 4 projects that it wants to buy. Quite annoyingly, it's being done via placing. Right, so it's not going to be open to normal retail investors, and it's not clear why that is. For a fundraiser that is as big as this, and for a timetable that stretches out to the end of November, there's no real good reason why they shouldn't have been given the opportunity to participate. It's not much of a premium, though, to NAV or to the current share price. So buying shares in the market does more or less give you the same result. So I suppose that's the only real compensation in this. It's not one of these issues that's coming at a massive discount to the normal share price. This announcement did actually drag the share price down. So there were 106p before this was announced. And so there's quite a fine margin, 102.2 to 101.5 offer price, which means it's going to be touch and go depending on what happens to markets over the rest of the month to see how this goes. Here's the portfolio split at the end of September. Obviously, they've been doing deals, so that's changed a little bit. Spread across US, UK, Australia, and Brazil, and a whole range of different investment technologies, but also quite a heavy emphasis on assets under construction. And that's part of the attraction of this, that because it's getting into these things at a very early stage, it actually gives it a bit of a kicker in terms of returns. Here's the existing portfolio, or bits of it. So I think we won't dwell on this because we talked about it before, but one of the ones that's relatively recent in here is this, the combined heat and power plants that they're building in the UK. So there's 2 in the portfolio already. These are burning gas, which obviously produces CO2, which is not great, but they're capturing that CO2 and then using it for other stuff. So the sort of things you might do is pump it into greenhouses and let that grow vegetables, for example, or maybe even capture it and store it and sell it. As we know, there was a shortage of CO2 not that long ago. So quite interesting projects, I think. And as we'll see, there's one more coming. So these are the 4 projects that they've lined up. So onshore wind in Mexico. I think that 92 million for 300 megawatts is actually quite reasonable price. Obviously, it's Mexico, but it does look as though that it's reasonably safe income. It's a long-term PPA, power purchase agreement, PPA, and targeting 10% plus returns. That's obviously very attractive. Run-of-the-river hydroelectric schemes in Brazil. That is one of the things you have to factor in with these funds. As they get more and more diversified, you do have to start worrying about all sorts of weird and wonderful things that you wouldn't normally have to worry about. So one of them is going to be Brazilian drought going forward. Obviously, with all these projects, as the portfolio builds out, each one is going to be less significant in the total. Again, they're looking for 10% plus returns, so we'll see how that goes. The combined heat and power plant we talked about before, there's the 3rd one of those. And then rooftop solar in Vietnam, which I thought was interesting because that is directly in the remit of the Thomas Lloyd Fund that we talked about last week that's trying to get away now. So if people are comfortable with it, that sort of thing in VH Global, then it's reasonable that they may be comfortable with it in Thomas Lloyd. So we'll see how that translates into orders for that fund. Lastly, from me, Scottish Mortgage, I just want to touch on this quickly. Obviously, markets have been through a bit of seesaw this year, really. We had the initial kind of value rally from almost exactly a year ago, the 9th of November last year, when the vaccines proved to be efficacious. And then that sort of petered out a bit later on in the spring. And then it took a while, even as people came back to growth stocks again, because they figured that new variants of COVID were keeping a lid on the recovering of the economy. It took a while still for Scottish Mortgage to get back onto a premium. You see that didn't really happen until September, October. But it is back issuing shares again, which I think was interesting. They've got 56.7 million shares in treasury, which obviously, given the share prices, is quite a lot of money. But that's all stock that they've issued and bought back again. I mean, it just shows you, I think, how good they are at controlling that discount and keeping it within quite a narrow band of where the NAV is. Now the premium is actually starting to look quite chunky. But that's partly because the NAV's taken a little tumble recently, and that's what's been exercising some journalists. It's still remarkably, given this sort of seesaw between value and growth, the second best performing global growth trust over a year, only beaten by VHGlobalSustainableEnergyOpportunities, which has obviously got more of a value tilt to it. So really not too bad, as we know the long-term returns are fantastic. This is the reason why things have been seesawing recently. As we remember, we talked to Claire Shaw a couple of weeks ago, and she was talking about the Moderna, which is a relatively recent addition to the portfolio and is quickly became their largest holding and something that they're very comfortable and they want to hang on to. And obviously, although they've sold a lot of Tesla, there's still a chunk of that in there. And then we look at the share prices of these two. Moderna first, that's a long way off its peak now. But the latest tumble, which is what's been triggering the headlines, was triggered recently. We'll talk about it in a second. And then also Tesla, we know, has come off. The Moderna position got to be so big because it had performed so well. So it added 7.2% to the NAV just in that 6 months between 31st of March and 30th of September, which is really enormous when you think about it, for a company that is, what, 22 billion market cap or something. But they've come out and said they're not going to sell as much COVID vaccines as they originally thought they were going to. But the argument that Scottish Mortgage has for owning Moderna is much more than just COVID. So Moderna's using mRNA technology to tackle all sorts of potential diseases. And so if they can pull off more than just COVID, there could be quite a good future for that stock going forward. And I doubt they're going to be too worried about this, and they're not going to become a position. They may even actually add to it. Tesla seesaw anyway, but as we know, Elon Musk has been talking about selling a big chunk of his stock and actually sold $5 billion worth already. But I also wondered whether people have switched into Rivian Automotive, which is the new IPO that came out this week. The major beneficiary of that in the sector was Third Point Investors. It added a little bit to their NAV because they bought some pre-IPO and then some in the IPO as well, and that's been doing quite well. So I'm saying really these are it's volatile, but this is nothing to worry about. This is exactly the sort of thing expect for Scottish Mortgage, and I wouldn't read too much into it. So that's enough from me for the moment.